Hello everyone, my name is Clément Gignac, Senior VP and Chief Economist for our financial group. Over the next 5 or 7 minutes, I will try to summarize, in fact, our monthly webinar that we have just recorded for our financial advisor, so you can consult on the PDF file attached to this Facebook Live. As a matter of fact, talking about the economy, no doubt that we have a deceleration of the global economy out there, and the sector who has been affected the most is the manufacturing sector. Keep in mind that China and US represent 45% of global manufacturing sector. So no doubt that this tariff and trade war that we have affect the global economy. As a matter of fact, this is the first time that we see that in more than 5 decades, that the global economy, global volume contract for the last 3 quarters. This is our first outside of recession. It's all due to this uncertainty. It's very tough for the board of directors, for big companies to invest when you don't know what will be the rule of the game next year. So that's the reason that we have this contraction of the global volume, and the manufacturing sector has been affected the most. What will happen with the trade war? Okay, your bet is as good as mine, but let's say that by mid-December, if nothing is solved, normally you have additional tariff. But I'm optimistic, so I think that you will have probably some commitment deal to be found, and they will probably remove this threat of tariff or kick the can, you'll see, and I will doubt very much that you will have tariff just 2 weeks before Christmas. So because if you have additional tariff with China, you have retaliation that will affect the stock market, and so no complacency. We have some possibility out there, but for me it's a minority probability, if you want, no more than 25% that you have this kind of things happen. So U.S. economy is not only about trade war. You have this U.S. consumer. As a matter of fact, U.S. consumer, U.S. consumption is so big that this is the biggest market on earth. It's bigger than the Chinese GDP, this U.S. consumption. So, and the U.S. household, U.S. consumer remain very confident. They have many reasons to remain confident. Interest rate is low. Unemployment rate is the lowest in 5 decades. They have, in fact, good financial assets. If you check the financial assets of the household at the time that the housing price going up, stock market is up, so they continue to spend. They remain confident. In addition, in terms of interest rate, what a change compared to a year ago. A year ago, you have Mr. Powell who continued to pull the trigger. The stock market declined by 18% in the 4th quarter. This time, it's different. So the market is already up 25% on Wall Street, and you have this Federal Reserve who has cut 3 times. The Federal Reserve has been able to cut because inflation remains under control. This is a winning condition to have a prolonged business cycle. So bottom line, on the economy, U.S. and overseas, we do see a very low probability of recession, and we see a prolonged economic cycle. Back to Canada, things perform very well in Canada. When you think about that, it's probably better than the perception. In fact, for the first 10 months of the year, you have already 350,000 job creation in Canada, and most of that is full-time from the private sector. This is the best sequence ever seen in 17 years. So very impressive. The employment population ratio in Canada exceed the previous peak of last decade, and it's much higher than U.S. So it's interesting. So that's the reason the Bank of Canada see no rush, no big worry to reduce interest rate. So at first, keep in mind they have not increased interest rate as much as U.S. to start with. Second, inflation in Canada is higher than U.S. So in Canada is 2%, U.S. 1.5%. So in this context, no necessity to match the rate cut of the Federal Reserve, and that's the reason that probably that explains the weakness of the Canadian dollar. If you analyze that, it's surprising to see a Canadian dollar so cheap, because now you have parity between short rates Canada and short rates US, and you have oil price at $55-60. So probably this political uncertainty, geopolitical uncertainty regarding what happened to the Mexico-Canada-Washington Treaty and the trade war as well. So Personally, as you know, I'm a portfolio manager. I manage money, diversified funds. I have the possibility to hedge or not. Since I see the Canadian dollar appreciate over the next 6 months, in this situation, I hedge portfolio, my portfolio. In terms of capital market, what is the expectation? Keep in mind that it's very surprising to have seen the bond rate decline so much. The long rates in US and Canada has declined by 100% since the beginning of the year, despite the fact that we have a very low unemployment rate and the stock market increase. So it's unusual. So we take profits, we reduce the duration. On the stock market, what will happen? Keep in mind that the bull market continue. As long as we see no recession and we have a long business cycle, you will have, in fact, probably the bull market continue, because to create a bear market, and the definition of bear market is 20% plus, is usually you need a recession. No recession, we believe the bull market will continue. You know, 25% return on the stock market, it's unusual, but this is not the first time. 20% return or more in one single year, that happened 24 times before since World War II. What happened the next year, this is what it's interesting, what is next. So if lesson from the past, 80% of the time, the stock market continue to deliver positive return in the following year. So I remain optimistic. We have the chance this month to share optimism as well with my colleague, Marc Gagnon, is responsible of Canadian equities. So I attach to this Facebook Live the PDF you can consult, but definitively, if some people search for more value, more defensive, less expensive market, Canada is very, very attractive, energy, banks, and so on. As a matter of fact, the dividend yield of Canadian banks is higher than a 10-year bond yield, so which is a winning condition to have a very good return in the following 2-3 years. So all in all, this is the summary of the webinar. I invite you to consult, but you know, sit down with your financial advisor as well. Each of us are different. We have different time horizon, risk tolerance. It's important to discuss the situation with your financial advisor. So on that note, I wish you a very good day.